Let's go to our featured guest of the morning. He's Colin Stewart, CEO and Portfolio Manager at J.C. Clark Limited. Thanks, first of all, for coming in.
Great to be here, Paul.
So this looks like the big issue at the start of the week for investors. Should it be? Should they be worried about the outcome of these talks?
I mean, it's one of those risks. It's hard to handicap, but it's something obviously a pretty small probability. We rarely see or I think never see it in the U.S. Breach that debt ceiling, and there's always a lot of consternation and worry right up to the deadline. And usually the politicians seem to find a way to get things done right before the deadline. So that would be our expectation here. And we haven't seen the market price in a whole lot here. I mean, maybe a little bit of weakness in the last couple of weeks, and worry about it as we get closer to that deadline, although there's no exact date as we know, but does sound like a little bit of optimism, as you pointed out this morning with another, we had a meeting last week between Biden and McCarthy. Sounds like another meeting tomorrow. So, our expectation would be that it's pretty likely something is going to get done, whether it gets done this week or next week or, in the near term. But again, we don't sort of really think that's the central issue. We think there's sort of bigger problems with the economy and market. But near term, this is obviously something people are focused on right now.
Right. Moving on to those bigger issues, you've told us in the past, and you continue to believe that a North American recession is likely. Why so?
Yeah, and we're not necessarily talking about a deep 2008 type recession, but there are a number of warning signs we see on the horizon. And I think importantly, it doesn't appear that the equity market is pricing in too much of that risk. We see things like, consumer goods and products companies talking about a real slowdown in demand for their products on the product side. Companies like Walmart and Target, what have you, big, blue chip companies. We've also seen a lot of the transportation companies in North America, things like trucking businesses, courier companies, talk about volumes being down. I heard someone say it's one of the worst trucking markets environments in North America they've seen in a long, long time. And usually that's a real leading indicator, because obviously those trucks are carrying the goods that people are going to buy. And the one, bright spot really, Paul, has been that the service side of the economy, as we know, things like restaurants, travel, hotels, airlines, very busy. But, I think that is likely to weaken going forward. That can only hold in so long. And, some of the other things I would point to, unemployment claims, which is a pretty key leading indicator we've seen tick up in the last, few weeks. And that's, I think something to keep an eye on for investors. The labor market has obviously been, very, very strong. But if people start to lose their jobs, and, that can be a, sort of a tipping point for the economy. Obviously, a, deeply inverted yield curve too, I would say, as a warning sign. And, if the market was very cheap and the equity market had been, down a lot in anticipation of a recession, we would sort of say, well, maybe it's all priced in. But I'd say on one hand, you have the Fed saying there's a recession coming, the bond market acting like there's a recession coming, and yet, the S&P 500 is still trading at 19.5 times earnings. So it doesn't really seem like equity investors are that worried. There's a bit of a, a disconnect there, we think. So
the Fed is considered to be near the end of its rate hiking cycle. That wouldn't change your view if the Fed said we're done now.
Well, and I think the market largely expects they are done now,
right.
and very likely that they're going to just pause for a long time here. And, obviously, I think if they see start to cut rates, it's likely in response to a recession or a real weakening in the economy. So I think that could obviously happen. And maybe, if you look at where the market is pricing, I think the market is factoring in about 3 rate cuts this year, and the Fed has come out and said, well, we're really not going to cut rates. Now they could, but, I'd say that if they do, it's likely because things are getting worse in the economy. So they may very well do that, but our view would be they're only going to do that if we see a recession. So just think there's risks on the horizon, and the market's really not pricing it in. At least the equity market is not pricing it in. Perhaps the bond market a bit more worried. You see economists talking about a recession. So it's sort of, there is that view. It's very widely telegraphed. It's just that the equity market is not really acting like there is a recession.
You're going to talk to us later in the next segment about uncorrelated investments for an uncertain market environment. Let's leave that for then. But what kind of equity exposure do you advise right now? What kind do you have for your clients?
Yeah, I mean, it obviously really depends on the type of client, the age, stage, all those types of things. But I mean, our view is it's a good time to be A, in defensive type sectors, B, holding some cash. I mean, there are obviously a lot of good alternatives for cash these days: treasury bills, money market funds, things where you can earn a higher rate of return. And so I think the bar is set higher for equities, and whether it's utilities or consumer staples, defensive type businesses that would be less economically sensitive, and sort of those types of sectors. And I don't think it's a bad time to be holding some cash as well.
Okay.